let's take a look at how to prepare direct materials budget, including schedule of expected cash disbursements for purchases of materials. At Royer Company, 5 pounds of material are required for each unit of a product. Management wants materials on hand at the end of each month equal to 10% of the following month's production. On March 31st, 13,000 pounds of material are on hand. Material cost is 40 cents per pound. Let's prepare the direct materials budget. To prepare the direct materials budget, we start from the required production in units from production budget. So here, for April, required production in units, 26,000, and May, 46,000, June, 29,000. We add up together 101,000. For each unit, it requires 5 pounds materials. For each month, we use the required production in units multiplied by 5 pounds because each unit requires 5 pounds of material. And we can get materials needs in pounds. So 26,000 multiplied by 5, and we can get 130,000. This is material required in pounds to produce 26,000 units. Then we can calculate the desired ending inventory. Desired ending inventory of a material should be 10% of the following month's production. So for April, we can calculate 10% of May's production needs. So we use 10% multiplied by 230,000, and then we can get 23,000. This is the designed ending inventory of materials for April. We add to production needs of materials for April, and then we can get 153,000. This is total materials needed for April, minus beginning inventory. Beginning inventory in April is the ending balance in March. The question has told us March 31st, 13,000 pounds of materials are on hand. So we put 13,000 here. We subtract 13,000 from 153,000, and then we can get materials to be purchased in April should be 140,000 pounds. For May, we can do the same thing. 46,000 units multiplied by 5, and then we can get production needs 230,000 pounds of materials. Add designed ending inventory, which is 10% of production needs in June. So this is 14,500. And then we can get the total needed 244,500 minus beginning inventory. Beginning inventory in May is the ending balance in April. So this is 23,000. And then we can get materials to be purchased in May should be 221,500. And same for June. 29,000 units multiplied by 5. And then we can get production needs 140,000 pounds. For designed ending inventory in June, this is assumed number. Based on previous quarter or based on same quarter previous year, the manager will estimate the ending inventory in June. And here, this is 11,500. So we can get the total needed and minus beginning inventory of June, which is ending balance in May. And we can get materials to be purchased in June, 142,000. Now for the whole quarter, total units 101,000 multiplied by 5. We can get production needs 505,000. Or if you add up for 3 months production needs, you can get the same number. Ending inventory for the quarter is the ending inventory in June, 11,500. And we can get the total needed 516,500 minus beginning inventory. Beginning inventory of the quarter is a beginning inventory in April. So we put 13,000 here, and we can get materials to be purchased for this quarter, 503,500. Of course, if you add up together for those 3 months materials to be purchased, you can get the same number. Let's take a look at expected cash disbursement for materials. Royer pays 40 cents per pound for its materials. 1/2 of the month purchases is paid in the month of purchase. The other half is paid in the following month. March 1st, accounts payable balance is $12,000. And let's calculate expected cash payment. For accounts payable, ending balance in March will be carried into beginning in April, and it will be paid. So we put 12,000 here. Now let's take a look at cash disbursement for April purchases. From the direct materials budget table we've just prepared, materials to be purchased in April are 140,000 pounds. For each pound, it costs 40 cents. So total purchases in dollar amount, we can calculate using 100,000 pounds multiplied by 40 cents. And you can get $56,000. The question has told us 1/2 of month purchases is paid in the month of purchase. The other half is paid in the next month. So 50% of $56,000 will be paid in April. 28,000 will be paid in April, and the other half will be paid in May. For May purchases, from the direct materials budget table, materials to be purchased should be 221,500 pounds. For each pound, the company pays 40 cents. So we can calculate the total dollar amount for the purchase. 221,500 multiplied by 40 cents. And we can get 88,600. Half will be paid in May. The other half paid in June. For June purchases, materials to be purchased are 142,000 pounds multiplied by 40 cents, and then we can get total purchases dollar amount in June should be 56,800. In June, half will be paid, so 28,400 will be paid. The other half will be paid in July. Again, we are preparing the quarter ended June 30th, so July's payment will not be prepared on this table. And for the quarter column, we can just add up together, and you can get the total cash disbursements for the quarter should be $185,000. Let's take a look at how to prepare direct labor budget. At row year, each unit of a product requires 0.05 hours, 3 minutes, of direct labor. For purposes of our illustration, assume that row year has a no layoff policy. Workers are paid at a rate of $10 per hour, regardless of hours worked. For next 3 months, the direct labor workforce will be paid for a minimum of 1,500 hours per month. Let's prepare the direct labor budget. From the production budget, we know required production in units for each month and the total for the quarter. For each unit, it requires direct labor 0.05 hour. So for each month, we can use required production units multiplied by 0.05 to get labor hours required. So here, for April, it requires 1,300 hours, May 2,300 hours, June 1,450 hours, and total labor hours required for the whole quarter 5,050 hours. But this company has no payoff policy, and the company should pay to employee at a minimum 1,500 hours. So for April and June, labor hours required are less than 1,500 hours, but because of a no layoff policy, the company still needs to pay 1,500 hours to employees. So if we can take a look at here, guaranteed labor hours, at least 1,500 hours. For April and June, labor hours should to be paid 1,500 hours. And for May, because required labor hours in May are 2,300 hours, more than 1,500 hours. So labor hours paid should be 2,300 hours. For the whole quarter, total labor hours should be paid 5,300 hours. For each labor hour, rate $10. So we multiply by $10 and we can get total direct labor costs in dollar amount. And if you add up together, or if you use labor hours paid total for the quarter multiplied by hourly wage rate, you can get the same number. This is total direct labor costs for the quarter, $53,000. Then we can prepare manufacturing overhead budget. At row year, manufacturing overhead is applied to units of a product on the basis of direct labor hours. Here, direct labor hours are our allocation base. The variable manufacturing overhead rate is $20 per direct labor hour. Fixed manufacturing overhead is $50,000 per month, which includes $20,000 of non-cash costs, primarily depreciation of planned assets. And let's prepare the manufacturing overhead budget. Manufacturing overhead for this company includes variable portion and fixed portion. MO allocation base is direct labor hours. So to get the total variable MO costs, we can use budgeted direct labor hours multiplied by variable MO rate. From the direct labor budget, we can get budgeted direct labor hours for each month. Please note here, these are required direct labor hours to produce products to meet production requirement. We are not using the direct labor hour paid because for April and June, required direct labor hours are less than guaranteed labor hours. So, budgeted direct labor hours total for the quarter 5,050 hours. For each month, we use budgeted direct labor hours multiplied by $20 variable manufacturer overhead rate, and then we can get variable MO costs for each month and for the quarter. Fixed manufacturer overhead costs $50,000 for each month. We add fixed MO costs to variable MO costs to get total MO costs for each month and for the quarter. Based on the total budgeted MO costs, we can calculate predetermined overhead rate. Remember the formula to calculate predetermined overhead rate? We divide total estimated manufacturer overhead by total level of allocation base. So here, we can use total MO costs for the quarter divided by total direct labor hours required. We divide 251,000 by 5,050 hours. And we can get predetermined overhead rate $49.70 per direct labor hour. This is a rounded number. For manufacturing overhead budget, we can also calculate the cash disbursements for MO costs. We were prepared on the same table. After we get total MO costs, we subtract non-cash costs. Non-cash MO cost is depreciation. Depreciation is not a cash outflow. So, to calculate cash disbursements, we need to subtract the non-cash costs from total MO costs. Then we can get cash payments for MO for each month and for the quarter. Now we can prepare ending finished goods inventory budget. We first calculate production costs per unit. Production costs include direct materials, direct labor, and manufacturing overhead. From the direct materials budget and information, we know each unit of a product requires 5 pounds, and for each pound, it costs 40 cents. So we can calculate direct materials in dollar amount for each unit. We use 5 pounds multiplied by 40 cents, and it's $2 per unit. For direct labor, from the direct labor budget, we know each unit requires 0.05 hours, 3 minutes. Wage rate, $10. So we use 0.05 hours multiplied by $10, and we can get 50 cents. This is direct labor cost per unit. For manufacturing overhead, the allocation base is direct labor hours. So the quantity here, we use 0.05 hours. For each unit, it requires 0.05 direct labor hours. Predetermined overhead rate, we just calculated. It's $49.70 per hour. So we can calculate 0.05 multiplied by 49.70, and we can get $2.49. This is manufacturing overhead cost per unit. We add up 3 together, we can get production costs per unit. Now, To get our total ending finished goods inventory, we use ending inventory in units multiplied by unit product cost. We calculated unit product cost, $4.99. For ending inventory in units, we can take a look at production budget table. If you go back, take a look at the previous slide. The ending inventory units should be 5,000 units. So we can calculate using 5,000 multiplied by 4.99. And we can get ending finished goods inventory in dollar amount, $24,950.